And now, from the Marquee Media Studio inside Mark Tank, it's the Mark Haney Show.
Yes, this is the Mark Haney Show, and we are on a mission to ignite the entrepreneurial revolution right here in the hometown we love, and we do that by building the backyard advantage, the most connected community in the world for local entrepreneurs, and we have a culture of love, showing love to our entrepreneurs. And today we are going to have an entrepreneur on the show that I respect tremendously. His name is Anthony Romano. He's the CEO of CREtelligent. We're going to learn about what he's building. It's a high-growth startup that is really changing one aspect of the commercial real estate and lending industry. So we'll hear about his story of growing his business through really what a tough economy. And we're going to hear a little bit about what's going on right now in commercial real estate. So there's some inside scoop that we will get. But before we get to that, we're going to bring you the J-Ezel question of the week. And this is really about if you're building a business and it's got a lot of value and maybe you have an exit or you decide to extract some of that value and get a payday, well, you want to have a plan. So what is that plan? J-Ezel is here to answer one of the questions you need to get right in developing your plan. And the question is, do I have a cohesive advisory team in place for this situation? Okay, question number 5. Do I have a cohesive advisory team in place?
Yeah, so that's one.
No. I'll answer that one for you.
Yeah, there you go. Yeah, it is surprising when we've been brought in an engagement and start talking to folks, and they'll have 7 attorneys between patents and all these different things lined up, and then we ask the question: okay, so who's advising you on your estate? Who's advising you on tax? These different parties of what we call a cohesive team. And we'd ask the question, and it's, well, I'm not quite sure. Or are these folks, are they working and are they playing nicely together for the benefit of you? And there's quite often that's not the case, because certain experts in certain areas, a patent attorney is not necessarily the attorney you want talking through transaction strategy. You want a business transaction specialist or talking through estate planning, because those are very granular strategies you have to think about. And then tying that together with tax and overall advisory, it's very, very important, because if you have that, at least in our experience, if you have that kind of cohesive, really highly operational team, it can really lend itself to a really efficient exit.
And now I'm here with my good friend, Anthony Romano, and he is the CEO of CREtelligent, which is a company that has been fast growth the last several years. And so I want to catch up on the company and then maybe talk a little bit about the industry, the state of, what's happening in the macro economy and so on, and how it might affect companies like yours or mine, right? So, Anthony, maybe just a little of your background and tell us what's going on with CREtelligent.
Yeah, well, this has been, first of all, thanks for having me again. And it's been a journey. I started this really in January of 2019. So we're 4.5 years in, and we have launched a platform as a service for the entire real estate ecosystem. The platform's called Radius, and it provides banks and brokers, REITs, owner-operators, attorneys, law firms, all the participants in multiple verticals, the opportunity to get micro market and property insights, to order status, get delivery of all the compulsory diligence that's done during a transaction. And then post-transaction, the monitoring surveillance of those assets, sort of across the country. So kind of an end-to-end
Is it kind of like a subscription type thing? Someone pays a monthly fee for access to data?
Yep, there's a subscription and enterprise license aspect, but then we have a lot of, per transaction, scenarios. So we have some of the largest REITs and largest law firms in the country where somebody might go buy 27 storage units or 13 multifamily properties in infrequent cases, maybe quarterly.
Well, I guess tapped into a favor the other day because I was working on something with Placer County, and they're saying you're going to need a phase 1. I'm like, what the heck is that? So I tapped into you, and you guys. Now, is your differential? So that was like a one-off because I'm not, I don't really develop much property, but can people utilize you sort of that way too, or was that just because I was, I tapped into a favor? Okay.
I mean, we don't proactively spend a lot of go-to-market dollars on the one-off, but somebody's buying a property and they need an environmental assessment or an appraisal or an Alta survey. Those are all pretty compulsory services, different than residential where, you have a home inspection and appraisal and really that's it on the property. There are 8 or 10 different things that banks and owner-operators and insurance companies require when you're doing a deal.
Okay, so you guys do appraisals too?
Yep. Yeah.
Okay, and when you guys do an appraisal, I assume you send somebody out there, or you do it? I mean, because you're kind of like a remote offering.
It's funny. So you think of the platform Radius as the UI UX to the client, as the order management and workflow platform. Behind the scenes, we've built an entire panel management technology platform. So on that platform would be MAI appraisers, environmental professionals, certified building inspectors, land surveyors. So all of those products I mentioned have a site recon component to it. And an individual will go out, they'll use our mobile app, do the data collection, take the photos, it comes back digitally into our report writing tool. Then we put it together, Opine, put the report together, and back it goes to the platform. So we call it tech-enabled services. There's a technology, there's great data, but because it's a pretty regulated industry, these things are required on 90% of the transactions. We provide the end-to-end service.
Okay, so there's humans. So you do have partnerships with the people out there doing a lot of this field work, I take it.
Yeah, the data. I mean, if you think about if you're an environmental professional or you're a building inspector, that's your craft. You might not be great at sales and marketing. So how do you go face off with hundreds and hundreds of clients to get work? Well, we do that for them, right? We face off with the bank, with the REIT, with the commercial brokers, et cetera.
Okay. Yeah. And so the business is, let's talk about the stage of the business, if you don't mind, because you guys have made an acquisition, and so maybe the stage of the business and sort of where you envision taking it.
We started, growing it organically, and coming from sort of the CoreLogic First American world, I learned a lot about the notion of you have no business doing acquisitions if you can't grow organically. So we started with real good organic growth, and then there were some kind of tuck-in acquisitions that we did. We did a couple small, and then last year we did a strategic acquisition of a business partner of ours out of Akron, Ohio, that was called Nexus CRE. And we've done the integration and a lot of cost synergies and revenue synergies. So it's been great. We'll do more. We're pretty opportunistic as the market's been hit pretty hard. There's a lot of really innovative technology companies out there in the space that are doing cool stuff but have a big burn and very little revenue. And we'll keep doing acquisitions. Okay,
so interesting. So I wanted to be a little bit educated here, maybe for our audience too. So don't do an acquisition unless you can grow organically as well.
Yeah, I mean, I think the idea would be, particularly from the investor, the private equity venture side, if all you're doing is get growth because you know how to tuck in companies, that's a different game. So we have a multidimensional where we say, hey, we have an organic strategy, we have an acquisition strategy, and then in the middle we have this partner distribution white label strategy where we've got a lot of companies who have pipes into the clients we want to work with, and we do arrangements with them in all ways and fashions. So growth strategy is multidimensional.
So it's real estate. So I got to ask you, everybody, yours is predominantly commercial real estate, as you mentioned, and I guess developers that are, developing some residential. You might utilize someone like that. Would a big home builder potentially be a client?
No, it really is the asset. If you think about, residential is single family, multifamily, one or two other pieces of property. Everything else is commercial. And I think people, my wife sort of said when I started this, because I'd come from residential and cap markets, what the heck do you know about commercial real estate? And it's like, it's everywhere. It's the gym you work out at, it's the office you go to, it's the school your kid goes to, it's where you shop, it's the pub you drink at. I mean, go down, everything's commercial real estate. And so we predominantly deal with folks, buying and selling and managing commercial properties. We work with developers who need some of those services, but it's a multifamily property whose, somebody owns it, somebody else is buying it, and we're working with the transaction.
So which segment of the market, which of those groups is like the biggest market for you? Is it the lenders? Is it the brokers?
It's right now I tell you certainly the lender, and when you say lender, think
like a bank,
think credit union, think community bank, think regional bank, think national bank, think non-bank, non-depository, bridge and mezzanine, lender and things of those nature. Those folks have a policy around asset class and loan amount and LTV, and based on that, here's what has to happen during a transaction. So they order a lot from us. Those are high volume clients that use our platform on subscriptions. But then the REITs, and then one of the biggest clients of ours are real estate attorneys. So they all have a practice that deals with large REITs and deals with corporate owner-operator clients. So they would work with somebody who's buying, 47 gas stations or 150 storage units, and they're helping with the legal and financial diligence, and then they need somebody like us to come in and do all of the market and property diligence.
And the problem you're solving, is it predominantly the hassle factor, so it saves a lot of time for the law firm, or is it cheaper? How do they get a benefit?
Any of those users, yeah. So think about the alternative. What would happen as a bank is, instead of coming to CREtelligent in this platform, right, and order status delivery of these end-to-end solutions, you would have a Rolodex of single-threaded monoline providers, and you'd either pick up the phone or you'd call an appraisal company or an environmental company or a survey company and you'd wait for them to respond and get a proposal, and then you'd turn it around and you'd look for your email, or you'd use Dropbox to get a report back, and really manual, very uninspiring and inefficient. This platform collapses the cycle time, reduces the friction in the transaction, improves the experience of all the counterparties in the deal. So it's been, we've been that's been the biggest validation, not just the retention aspect of the client that we've enjoyed, but the feedback and utility they get has been bananas. And we just did our 3rd Net Promoter Score, where we talk to our customers and survey them. Industry average in our space is somewhere around 40 or 50. Our score was a 74. I mean, it sounds super arrogant, but I think it's less just the technology and the platform, but we flank it with world-class customer service. When somebody's buying 38 storage units, right? This is $100, $200, $300 million transaction. You got to lean in and be part of the transaction with them and help navigate and interpret and almost be part of their deal team. So we say high tech when you want it, high touch when you need it. We sort of flank it with customer service.
And it's kind of like a one-stop shop versus having to call 5 people.
Commercial real estate storefront workflow system for end-to-end due diligence.
Interesting. Yeah. Okay, yeah. It's I can see it being super. Is it cheaper than calling? Is it more affordable because it's sort of a subscription
not only
thing?
The service is probably really competitively priced, high quality and fast, but the efficiency that's gained. We have clients who said, "Hey, we've taken 7, 8, 9 days out of our process." And if you're a bank, you just did a transaction. If you're a bank and your borrower gets to get into their property faster, less expensive, and start running their business, that's a huge win.
Yeah, 100%. Okay, so everybody's talking about artificial intelligence. We're investing into a lot of startups that are dealing with artificial intelligence, and a lot of it is around driving efficiency. And is that going to be a piece of what you do, or is that a piece of what you do?
We're working on it today. There's a local company. It's a Moneta portfolio company called App Orchid that we spend a lot of time with. We've built our ontology. We've built sort of
one of our company. We're invested there too.
Yeah. Okay, so we've built our data fabric. I mean, we see both a use case internal and external. And I think internal, when you think about using the computing power to reduce the cost and the time it takes. So for a phase 1 environmental assessment, as an example, it might take a report writer, an expert, 8 hours to put that together, compile it, etc. ChatGPT just passed the CPA exam last week on the first try, right? we have models internally that we're working on, cutting that time in half, and then a human QCs it. So if you can double your output and not linearly grow your FTE, it's a home run. So internally, we see a real opportunity for the client when you think about decision intelligence and all of the disparate data sets and places somebody has to go to make a decision. Just think about like location logic. You're looking for a site. Mm-hmm. Well, if you use AI and our front end to come in and look at location biases, stay duration, traffic patterns, income composition, all the demographics to say, hey, this is the right place to look for a site. So I think there's a ton of use cases in the commercial real estate world, and we like to be out front.
It makes sense. I mean, we're using it around here, kind of at a small time level with ChatGPT a little bit, and there's we have actually a podcast. The stuff that there's ways to make our podcast more efficient and stuff like that. So we're. It feels like it's taken the world by storm, similar to the way you've taken, the commercial real estate processing by storm. It's just creating, so much more efficiency.
Early innings in it. It's really neat. And it's funny. My wife said, "Hey, does AI replace humans?" And I said, "I think humans that use AI will replace humans. There's no doubt about it. I mean, the power of the computing is pretty special."
Yeah. So. And maybe we'll have time to make more complex sort of creative decisions and collaborate and things like that instead of process all the time. We're always running these processes when, my goodness, somebody, the machine can do it.
No doubt.
Very cool. Okay, so everybody's probably wondering your view on the commercial real estate market. You're probably at the front end of seeing where that might be going. And I know that's a broad market. We brought up multifamily. There's obviously industrial, retail, office, and so on. Give me, and then we get the banks tightening up too because of the problems with Silicon Valley Bank and so on, and interest rates being up. Maybe just help me understand your perspective on this landscape.
Yeah, I mean, you had blockbuster years in values and transactions in sort of 1920. Or 19 and then going into 2020. The pandemic obviously changed everything, and you had the Fed, sort of rightfully so, ease and make money available and things of that nature, and so interest rates went down precipitously. Right, the Fed had it was 25 basis points on the Fed funds rate. Fast forward, get out of the pandemic, valuations are going up, interest rates are still low, access to capital is great, and transactions were going bananas. So the Fed has raised rates 10 times. Just pause for a minute, but that took the Fed funds rate from 25 basis points to 5. So if you think about cap rates, which is the yield on an investment, when your cost of capital exceeds your cap rate, you're inverted. It doesn't make any sense. Mm-hmm. So right now, the dynamic that exists, and it started really in the third quarter of last year, you saw transaction volumes for all asset classes. Everybody talks about office because that's the work from home, and now we're back to this hybrid, and you've got 60% occupancy across the country in offices. There's no doubt that asset class has been impacted the most, but all transactions slowed. In fact, year over year, commercial real estate transactions are down almost 70% across the board. And that's a function of the values high of the property and the cost of capital has increased. What we have seen in the last really 60 days is valuations declining. And that has to happen in order for deals to get done. There is historic amounts of uninvested capital and liquidity on the sidelines right now. So we have talked to tons of our customers who are just waiting, who buy, either single properties or multi-site or, big portfolios, and it will come back. I mean, historically, when you think of where these rates are, they're not historically high, but relative to where we were 12 and 18 months ago, it's bananas.
Yeah. What about building? And people aren't building new either. Is that right? I mean, you got the transactions, but then new development.
Yep, I think there's some. I mean, in certain asset classes, there's some. Certainly in storage, industrial, there's still a lot going on in that area. Student housing, and there's still some multifamily. But yeah, you're right. The trading of these assets or portfolios has slowed. We're starting to see it pick back up, and I think that will continue as people get line of sight to where these rates land and understand where these, where the valuations of the properties are. It's funny because you have people talking about, well, the property value is down 20%. And it's like, well, you bought a stock at 10, it went to 100 and it's at 80 and now you're a mess. Well, come on. There's still equity in these properties. The difference between residential mortgage and commercial mortgage is they're much lower LTVs, right? These are 60% LTVs. So you buy a $10 million building, you're coming in with $4 million. So to get underwater, to be in a negative equity situation like we saw in 2008 and 9 on the resi side, really hard to do. I do think there'll be some distress. We're starting to see some delinquencies. You mentioned it, not just the banks that have those couple banks that have failed, but every bank is looking at their real estate portfolio and they've tightened the credit box. So that means less fits in there in terms of underwriting standards. So it'll be a little harder. Rates are up, standards are harder. So you're seeing private lenders and other folks that have debt lending and things getting into the mix to help, because the other dynamic is you have almost $1 trillion over the next 3 years of CMBS, which is loans that have been securitized. Those loans are coming to maturity. And most of those loans are interest only. There's zero interest.
Yeah, and for our listeners that might not be as familiar with commercial real estate, you might be thinking of your house. You get a 30-year mortgage, it's paid off at the end of 30 years. A lot of people are locked in at 3 and 4% interest rates, and they're not really selling their houses right now. They're kind of just hanging on to it, maybe even turn it into a rental at some point if they want to get something new. But you're not going to. There's not a lot of houses getting sold with a 3% interest rate right now.
No, I mean, the purchase market, it's down, but on the resi side, people move and kids, you get a new job and kids leave, and so you buy a new house, and that will maintain. To your point, you have 90% of residential mortgage holders under 4%. Rates are at 5.5%, 6%. You're not refinancing your mortgage.
Right.
So refis are down 80% on the resi side. So there's no doubt that the macroeconomic, and I get the Fed's got to fight inflation, et cetera, but I think they're starting to see the impact of lending and the tightening of the access to capital. So we'll see.
But on these commercial loans, like you mentioned, I'm going back to that a little bit, but what our listeners might not be thinking about if they don't own commercial property, there's these loans against that stuff that are, the balloon payment is coming due. So they're going to try to refinance it at a time when the interest rates are higher, so it's harder to afford the payment. And then also the banks are tightening up as well. Yeah. And your property's probably worth a little bit less. So you got kind of like a triple.
You got to come in. You got to come in that scenario, and it's not just the maturity of those, because they're normally not 30-year. The loan products in commercial are 10 and 15-year loan products. So you got to come in with a lot of capital, okay, or you got to do a transaction. We're starting to see delinquency up. I think a lot of those will cure, but we will see defaults. We will see REO, transactions, and for CREtelligent, as bad as that is, that's all our services.
Transactions are good.
All our services are required there. Yeah. I don't think it'll be anything like we saw, when you had esoteric loan products and crazy stuff going on the resi side back in the day. But it'll be. We're navigating at CREtelligent. It's impacted us, right? So market's down 70%. We've seen 30 and 35% declines on revenue, right? We had this crazy 25% quarter over quarter growth for 8-9 quarters in a row, and we've definitely seen an impact to our transactions, our orders, and our top line. So we went to the middle of the P&L, like any good leadership team would do, and you start to right-size operating expenses.
Yeah, I have to imagine. I want to dive into that in a second. So you mentioned that there's a lot of money on the sidelines. So in terms of like protecting the economy, people are going to be able to come in and refi and put a little more cash into the debt, into the loan, and probably minimize some of this foreclosure type of
for
scenario.
sure. I think it'd be minimized. I think when I say money on the sides, what I see is, if you think about, and he just passed away, Sam Zell was really the father of the REIT, which is a real estate investment trust. It's a vehicle that allows investors to put money in commercial, in different asset classes, that's publicly traded. You now have, if you think of the Goldmans and the Blackstones and the Brookfields and hundreds and hundreds of endowments and various funds have a mandate to this asset class. That's just like they invest in equities. This is a big asset class. There's lots of money waiting to be deployed to buy commercial real estate. And what has to happen again is line of sight to where these rates land and valuations to make sense, so cap rates and yield make sense. So I really think we'll see a surge in transactions as we get into the third and fourth quarter of this year.
What about alternative lenders? So if the banks are tightening up, other people jump in to fill that gap, I assume, because it's a business that you can make money on, even if you're a non-bank.
Many clients of ours are in that what we call private lender. They do these mezzanine loans, bridge loans for a period of time. So absolutely, yeah, I think you'll see more non-banks in the commercial real estate transaction. You saw it big on the resi side. I think you'll see it more in the commercial side.
When you said go to the middle of the financial statement, so in terms of solving your maybe expense, having too many expenses, What does that look like? Is that headcount, or is that? I mean, how do you approach that?
Yeah. Yes. I mean, for the most, when you think about from a revenue standpoint, right? You sell and you can increase your prices. Mm-hmm. For your COGS, you can reduce your data costs, your service costs, etc. What's left is gross margin percentage in dollars. That covers your operating expenses, right? So the higher your revenue, the higher your margin, the more you have to cover OpEx. For us, and it's interesting when you think about some of the venture and private equity guys that we chat with, our margin profile blended was somewhere, close to 50%. A lot of the SaaS and software and technology guys are like, we like it 60, 65% margin. Well, you're talking about a $10 product. Our average revenue per order is almost $2,000. So that's $1,000 to drop to cover OpEx, right?
Yeah.
So whatever is in that gross margin dollar bucket, you have to be able to cover your operating expenses. Yeah, for us and for many companies, like us, technology businesses and tech-enabled businesses, you got 70 to 80% of your OpEx is FTE and associated benefits and payrolls, taxes associated with FTE. Mm-hmm. So we were fortunate in that when we did the acquisition, there were definitely some cost synergies that we knew we could realize. You don't need 2 AP clerks and things of that nature. And then we also moved to this model. I mentioned our panel. We had a lot of W-2 resources in-house because I was not comfortable with our turn time, our quality with the panel. And this is going back probably 8 or 9 months. As that improved and we got really comfortable, we made those changes. So we reduced our OpEx by 48%.
Have you had to do this type of thing in your career before? I have, and it can be painful. Maybe for me, I live a little more emotionally in terms of, the people side, and when you have to let friends, go, that's a difficult thing.
Super. I mean, there's no question that it would, particularly when you care about culture and ethos and wellness and collaboration, inclusion, you're trying to create a great place to work. You can't control the external environment. I love being optimistic. I hate being optimistic about things I can't control. Mm-hmm. And the environment is one where everybody knows. We've been, really clear with everybody and sort of said, hey, this is where we are. Here, if these things happen, we'll have to make some change. That could happen in non-FTE expense. It could happen in reduction in pay, and you could go to 4-day work week, lots of things. But at the end of the day, you got to look, at the leadership team and say, look, our job, we got a lot of constituents, the employees first. We've got big investors in this business, and we've got important customers, and we're a going concern. So we've got to do the right thing, and that's never easy. And you do it with grace, and you do it with compassion, and you make sure you provide a safety net and a severance, and you help people transition to the best of your ability. But it may be more so in real estate. I mean, in a past life on the resi side, when rates went up, I mean, you had massive changes you needed to make. And the longer you wait, the worse it is for the employee, and the worse it is for your EBITDA at the end of the day. So you got
let everybody go get a landing spot. And that's interesting because in 2008, we had to make, my old company, we had to make some really difficult decisions along these lines too, because all of a sudden, our revenue would drop dramatically. Yeah. And I have to imagine people that are I've heard that within mortgage, and dealing with residential mortgage and stuff, that just being in the right spot here, you got to find a landing spot if you're in one of those type of positions. And I wonder how artificial intelligence is going to affect that as well, because some of these jobs might be eliminated because of that too.
For sure, no doubt. In real estate, I think it probably is usually a lagging industry to some of the other industries. We're starting to see adoption and people really thinking about how do we take cost out and how do we reduce the time frame to get stuff done using these innovative technologies, using sort of natural language, etc. It'll come. For sure.
So once you right size it, then and you mentioned communication. That was my big thing. I probably over communicated because I just wanted everybody to know the truth from the CEO, right? And just give it as much as I can. But now that you've sort of done all that, now you've got to communicate a growth strategy or a strategy moving forward that looks positive. What does that look like now in terms of like? What are you communicating to the team? What are you communicating to investors, customers about the go forward plan and why it's going to be better than it is today?
Yeah. Well, I think the foundation was, the utility these clients get. Watching in all of these verticals, clients really satisfied and having a big ROI with what we're doing. So we know beyond product market fit, we know this solution set and what we're doing impacts our clients. In this market, if you think a bank, the bank was doing 10 transactions, now they're doing 3.
Still get the customer though.
Yeah, we've still got the client. Their transactions are down, but they're hurting too. So our message has been to our team, now's the time to lean in. I mean, really lean in with our clients and help them get their transactions done, get the information, make the decisions fast, so that as things recover, where you had, 3 vendors that you used when you did 10 transactions, well, as things come back, it might not go back to 10, but it might be 5 or 6, and you might just have 1. We might actually come out ahead from a orders and revenue perspective.
Yeah, that's interesting, because I would think on something like this, I was going to call it a land grab, but there might be a way to grab market share, right? Because you're providing something that's going to allow a bank that's maybe needs to reduce some headcount, or some other organization that's thinking about reducing headcount, and was like, look, come in with our solution, and it's going to create a lot of efficiencies for your
no doubt. Where they
business.
had 4 or 5 people in their group, and now they've got 2, they can go back up to the same volumes using our technology without adding staff. And so that's a great thing for us. What's been the silver lining, I think, in the real estate debacle that's going on, is we can get airtime with a lot of people. They're willing to look at new technology, new innovation. I think particularly in commercial real estate, I think the adoption of technology, it will be evolution and not revolution. And so, but they're more open now to, all right, how do I take cost out? How do I do things faster? How do I have less FTE? And how do I make sure I don't mess the experience up with my borrower? I improve that. And we play, really well there.
So in terms of market share, do you have a sense as to the size of the market, and then where you guys stack up in terms of market share? Like, how much is there to grab?
A lot. Yeah. I mean, I tell you, it's probably a 15 to 20 billion dollar. When you look across before, during, and after a transaction, and all the data and analytics, all the services, all the solutions, all the platforms, it's a big market just in the commercial world. And so, we've got 800 clients. We want to get to 2,500, 3,000 customers, and they're in these key verticals. And the beauty is once you crack the code with a specialty insurance provider and you see the value they get, where it took them 4 hours to do what you showed them how to do in 15 minutes. Well, there's 38, specialty insurance firms in the country. Now you can just propagate right through and go bring them a solution. And we've got now 6 of the top 10, and we'll keep going there. And you can kind of do that in each one of the verticals when you understand each node in the client's process, what they're trying to get done, what their alternatives are, how much they spend. And so, we've been really fortunate there.
Yeah, I would think adding new clients would be, a big focus right now, because you've got your product's really sticky, and so you just need to collect more clients.
Both, I would tell you, it's funny because we've been acquiring about 75 new customers a quarter for the last 2.5 years. Right, that's a big number. Where I think we have a real opportunity now is we've been focused on new customer acquisition, but the entry point of each of those clients may be, I came to you for environmental pre-screens, I came to you for appraisals, hey, I want to manage my assets here. And they don't really understand the depth and breadth of what we do. So the opportunity, I think we could double our revenue and not bring in a new client, just wallet share expansion.
And when you're adding new product offerings within your platform, but I guess some of it's just training, just a basic understanding of, oh, you guys offer that now too? You offer that now too?
Sure. And the old adage of, the user doesn't buy, the buyer doesn't use. So somebody who's using us to place orders, et cetera, that's not the individual that you talk to about adopting all the other things you do. It's usually the head of lending or chief credit officer, depending on the institution we're talking to. So you got to navigate the organization, and we've got tons of opportunity. We've got big law firm client that spent $800,000 with us, and everybody said, "Oh, that's great. These guys spend a lot of money." So that was their Chicago office. The other 8 offices never heard of us, guys. Just so you know. Yeah. So we can go horizontal in these customers in different functional areas of their business and in different locations and expand what we're doing.
Okay, we were talking a little bit about money on the sidelines in real estate, but venture capital is sort of a world that both of us have some familiarity with. You've raised money for your business. You guys are a venture-backed company. Yep. You mentioned Moneta. I believe they're an investor. I'm a very small-time investor into the company. And that world has changed at some level because of what's going on the macro economy. And interest rates going up has affected that too.
Yeah, because you get yield in a lot of places. Right now, venture has a charter. and their LPs expect, something to happen over a 3 to 5 year, sort of period. And you're right. 18 months ago, the discussion with either venture capital firms or private equity, growth equity guys, it was very different in the what they were willing to do to deploy the capital and make the investment, and the metrics that they cared about, in terms of where you were in that journey. So it was, everybody goes, oh, grow at all costs. I don't think anybody really ever said that. And no venture firm, when you hear people say, oh, they're placing 10 bets and they just want one unicorn. I haven't found a venture firm that places a bet. They do their diligence, okay? But there's no doubt you do 10 investments, as good as the diligence is, and you believe in the management team and the market, 4 or 5 of them don't make it. And then you hope that 1 or 2 do pretty darn good and you get more than your money back. And then 2 or 3 of them, do really well and you get 7 to 10 times your money. And that's how the IRR for a fund returns 20 and 30% to their investors. So it certainly was acquire clients, grow revenue, add users, create a competitive moat. And we were doing that. We weren't doing it with an outlandish burn, but that was often acceptable. For a lot of these venture firms to say, hey, continue to invest in the business. Look, it's working. And then when things turn, it's so irresponsible in my mind. So you can't be positive EBITDA and cash flow early stage. It just, it doesn't make any sense to do that. Or it's going to take you 20 years to grow your business, right? But fast forward to now, and we're in the midst of some additional capital raises. We've got folks coming to us, which is kind of cool. But the things they care about are cash flow and EBITDA, and you don't need to necessarily be there, but you better have a line of sight and a really clear plan to get there, because the irresponsible burns. I mean, the number one adage is don't run out of capital. Right? If you're in year 1, year 2, year 3, don't run out of capital. Survival is all that matters. Everything else is just words. Like, it doesn't matter. If you run out of capital and you've raised 10 or 20, you're sort of done. Or you get to the end of that and you realize you're over a barrel, right? You got 4 payrolls left. You got 100 employees. Yet the business looks good, but you don't have the capital to continue. And then you get into down rounds and really ugly, bad stuff.
You got to get out in front of it with maybe it's headcount at some point, or some option. So in terms of that, there still seems to be a lot of money on the sidelines. They want to invest, they're looking at different metrics.
Selective. And I think when people ask, but when you raise, what's the process and how do you sort of think about it? The first thing, and I made this mistakes, right? Every one of these funds, there certainly are some general funds, but most of them have a thesis, right? They've sort of signaled to their LPs, I'm going to invest in biotech. I'm going to invest in real estate and prop tech. I'm going to invest in companies that are cash flow positive. We only write checks because we have $1 billion fund of 25 million or more. So if you're raising capital, you got to know that. All these funds on their sites, for the most part, you can ask, what's your criteria? What's your investment approach? What's your thesis? So to waste time on a lot of folks that, hey, I'm raising $5 million. Great. Our smallest check's $20 million. You waste a lot of time. So understanding the makeup of who those those folks are is important. And we now have a group that we work with and that have continued to keep up to date on how the boat's floating over, a long period of time, have watched. And I think that's the big difference between early, seed and certainly Series A. Series A for me was aspiration. We could talk about, again, a great leadership team, incredible domain expertise, great experience, trickle of revenue, good concept. Here's what we're going to go do. And people invest in that regard, right? Because they will believe in that. When you get to Series B, I use B as bullshit. Like, hey, man, there's no fake in it. It's called historical financials. Here's my last 12 or 24 months, right? So you can't come in and say, well, you said you were going to get 1,000 customers, you got 500. You said you were going to do 17 million, you guys did 8 million. You said, so that didn't lie. So now you're at the metrics, in my mind, where you've got to be really clear on revenue and margin and OpEx and EBITDA and cash flow. And yes, IP and yes, users and yes, NPS, those matter, but the financials are where these guys are at. And then what can this become? I mean, these aren't affinity investors, right? They have LPs that want to return. So they have to believe that over the time horizon of their investment, they're going to get a real return. And knowing that, is super important. I mean, matters in the conversations, in the pitch deck's great, but the real work starts when they start with diligence and look at cap tables and pro formas, historical financials, revenue cohorts. I mean, there's just a lot you got to be prepared to have an adult discussion about, and come out the other end.
It's interesting that you're bringing this stuff up, because these are sort of big boy type of, or big girl, I should say, big. Yeah. They're deeper discussions. It's real business. A lot of the startups that are in their very early stages, they're kind of product people, right? They've built this cool product. They're organizing the business, and they haven't necessarily sat at the helm of a company that's your size or the size of the last companies that you have built. And how important is that experience? I mean, can you get the on-the-job experience in most cases, or because you're in the fire if you're a startup, but I mean, CREtelligent's lucky to have brought you in from the outside and a professional CEO.
Yeah, I mean, I do think, thank you for that, but I do think that the product folks and the engineers and the technologists that have, the chops there, if they surround themselves, I was really fortunate with you, with Lokesh. We go down the list of people in this region who helped and leaned in and helped navigate that process a little bit. Yeah, I had some experience, but it was very helpful. I think that exists for a lot of your portcos right now. Mm-hmm. You'll be with them by their side as they go out and have those conversations. But to be prepared, you're going to get caught flat-footed. There's no question with private equity guys doing diligence, but you can only get caught flat-footed on the same question once, right? When they talk about subscription models, when they talk about revenue cohorts, when they talk about margin profile, you can get flat-footed once, but then you got to be prepared, because the next firm's going to ask you that, and that's what matters to them and how they look at what how much they're going to invest.
Okay. So let's talk about the relationship with a company like Moneta, and if they're your lead investor, what's the expectation of someone like that from you, of how they might help you navigate getting that next round, or helping you prep to scale the business?
Yeah, I mean, they have a lot of portcos, and many of those, as you know, have been wildly successful, not only in terms of where they are in their journey and their growth, but big exits. And Moneta's team is fabulous. They've been massively helpful. They help with investor briefs and executive summaries and pitch decks and all of the diligence, building a data room and how to be well organized. And they've been very, very helpful. I'm super fortunate. Our CFO, Chris is, MBA from USC, Price Waterhouse, he's Ernst & Young guy. But beyond that, he's got the chops to build models and build data reports. That's what these investors want to see. And if, again, it's in that aspirational stage, it's what we might do. If it's what you did, you've got to be able to put that in the right context for here's what happened, here's why it happened, and here's where we're going with it. And so having a really good investor and a really good leadership team, who's particularly in the finance side.
Yeah. It's interesting, because when we decided to start the Growth Factory, I made 3 calls. One to Dale Carlson, who sleep train guy, sold, philanthropic man and just a great businessman. He was the first call, and he said, he's like, how do I help, Mark? Second call I made was Barry Broom, who does all the economic development stuff around town at GSEC. And the third call I made was to Lokesh from Moneta Ventures, the 3 people that I felt I respected most in this world and could help give me some feedback on our dream. And all of them said the same thing. What are you working on? How can I help? And so Lokesh and Moneta has come on as a formal advisor to the Growth Factory Ventures Fund. Yep. And it's like having my teammates are great. I've had some experience doing angel investments, but having Lokesh and the Moneta team sort of there as our sounding board and with guidance, it's been invaluable.
They were entrepreneurs that learned how to be VC, so they sat in our chairs. They get it, which is beautiful. They'll be winners in a big way out of this, and I'm so grateful for that relationship. They're, I don't want to say generalists, but when I think about now where we're looking, the funds that we're talking to now, all of the LPs of these funds are commercial real estate holders.
Interesting.
Right? In other words, it's more than just capital now. They can bring strategic value in customer relationships, business partner relationships, right? So does that make sense?
The LPs of the funds that are investing in you. So just so our listeners know that when somebody has a fund, they have, let's say, 100 investors, and these people are the minority share. They all own part of this investment, and so it could be a big group of people, right? So a fund comes in, right? The general partner, and they make that investment, but then each of the people that are investors they can add value.
No doubt.
And
So
you can tap into those
the
people.
individual LP, limited partner who makes an investment can add value. Also the firm. So many of the private equity guys we're talking today, their investors are CBRE, Cushman and Wakefield, Heinz, Hilton, Walmart, folks that have a giant commercial real estate footprint, the biggest multifamily owners, the biggest warehouse and storage owners. So those folks all make investments in all these, and they can introduce you, because part of the private equity guys want to see, hey, is there real value in your product? Let's go talk to some of our LPs and see, would they use it? And so far it's been really
That's
good.
a great
And
way to grow the business, then, is through your
that's part of the advantage. So you say, hey, can you bring more than capital? Can you help me with pricing and packaging and subscription model? Can you help me with business development and relationships? Do you guys really understand acquisitions and tuck-in acquisitions? And those are the kind of firms that we're talking to now. That becomes really valuable. There's many kind of vertically integrated commercial real estate companies that have started venture arms. So think Prologis, Divco West, BH3, Brookfields. They all are big commercial real estate players. That's what you'd think about. But they all have hundreds of millions of dollars in growth equity capital that they take bets on in companies that can impact their real estate business.
Yeah.
Which
in
makes
fact,
sense.
Did you ever meet the guys from Hank?
Yes,
in town, right? They have a.
they sold the JLL.
They sold the JLL, and that's they're part of their venture arm bought them. So that guy's been on the show. I was an investor into that company as well. So it's interesting to think about the different synergies that they can pick up by buying that type of company, or buying. It could be someone like you or someone like Hank. Very cool, and that's kind of part of the backyard advantage thesis, is that we can get our limited partners from the growth factory. We can get the partnerships that we have with cities and counties and the Kings and colleges and universities to be early adopters to some of these startups. When they start to get their first customers, hey, let's try out the product a little bit. Let's be an early customer. Get them a little bit of capital. And, at the heart of what we're doing is like bringing love, right? So if we can, and ours are all Sacramento, right? So ours it's sort of interesting because we're in this little fishbowl where we all kind of know each other because it's a small town. And so we're thinking that actually can be an advantage. And we've seen some of that begin to happen for our portfolio companies and for other friends that are coming through our networks as well. So
tons. This region's come a long way in the last several years, and what you guys are doing is a big part of that in terms of entrepreneur and business and things of that nature. But the introductions that we've had, so banking relationship. Beckwith and Rizzo. Not only have they been great advisors, but they've been
five-star bank.
Five-star bank, and they're a great customer of ours. And look, they're not going to use us because we're their buddy. They're going to use us because they get great value and utility, and then they're going to tell other people about it, right?
Yes.
So we've been the beneficiary of the region and these relationships.
That's
so
great.
It's been cool.
That's really cool. Okay, so what else? Okay, so I want to talk about you as a CEO. You got recognized by Ernst & Young as being one of the top
cool.
CEOs.
Yeah.
What happened? What was that all about?
So Ernst & Young, they're everybody. I think most people think of them as tax and audit. They're a world-class, one of the most iconic professional services firms in the world, headquartered in the UK. They have this whole Entrepreneur of the Year program, and they spend a lot of time, much like you, but in a different form and fashion. They've got a lot of people dedicated to how do we impact communities, entrepreneurs, small businesses. They actually do a lot in venture and things. And around the country, they do these Entrepreneur of the Year type of awards. So somebody nominates you, you write 5 or 6 long essays, you answer a bunch of questions, you do, set out financials. They had folks come up to Sacramento, you spend, 90 minutes in an interview, then they start with whatever 1,000 people and they narrow it down to 70, 80, 90. You go down to Palo Alto, you're doing these interviews with private equity and they're kind of advisor guys. And then they narrowed it down, and it was really super humbling because the people that I was with think this is Silicon Valley. Some of these guys are curing cancer, putting shit on the moon. It was unbelievable in terms of the businesses, really blockbuster businesses. So very humbled and honored, and they got it down to 29. And I think they picked 4 or 5 to go to the national CREtelligent, and I wasn't one of them. But it was a really cool event that happened earlier in June out in San Francisco. And I just appreciated the opportunity. For me, it was less about the Anthony Romano brand, but how does CREtelligent, and we've had investors come, we've had business partners, data providers. You just, you elevate the business and what we're doing, and more people are like, let me talk to those guys. So we got a lot of
being the CEO, it's your job to be at some level the face of the brand, and move the molecules in all these different ways. And so that's a good group of people to be around.
It was great.
So, yeah.
Yeah, the whole process was really fun.
Okay, so what did I not ask you? What else you want to talk about today? What's important to you right now?
I think it's interesting. I love this region. We've been so, again, big beneficiaries of it, not only with business partners and investors, but employee base here has been amazing. And in these kind of times, you got a lot of companies that are doing massive cuts and changes. And our feeling has been like you could buy people's back, right, with earnings and bonuses and stock options, but you can't buy their heart. And you got to create a culture and a foundation that really is honestly matters, where people say, I want to be part of this. And part of that is what we're doing. Like, I want to have my fingerprints on something that is really impactful, that's going to blow it out. And I think that we've got a lot of people in the org right now that are pretty excited about where we're going. And when you're, a venture-backed business, it doesn't always mean, you sell the company. There's recapitalization, there's IPOs, but there's an end to this. And so, our leadership team has said, hey, we want to run really hard over the next 24, 36 months. And then we'll see. I mean, we'll have acquired a lot of clients. It'll be a competitive moat. The platform's there. We've had 2 or 3 firms come to us and say, hey, we're really intrigued with what you're doing. We're just in an adjacent market. Would you want to talk about? And it's early yet. And so we'll have more of those conversations in the next couple of years. But yeah, it's been really exciting to see it grow and succeed.
All right. So last question. I got to, one of the things that you and I have in common is we're family guys, right? So we were talking about your daughters and, they've gone off and got their degrees at great schools and they're getting good jobs. And, you and your wife have been married how long have you guys been married?
I took her to sophomore homecoming dance in high school and been together ever since.
Yeah, I knew it was like forever, and not that you're that old, but it's like it takes a while. But it's interesting. So any words of wisdom for that? Because you see, there's a decline in families at some level, and so I always feel like, when I meet someone like you, I want to help bring out that story a little bit about, look, you did some things right. Any advice to men out there or anybody? Because your kids love each other too.
I thank you for that. I did a couple things right. My wife did a lot right. and you're absolutely right that we're super blessed. Olivia and John, the daughters, they're best friends, and I've never seen them fight, and they share everything. And it's such a unique scenario, but it made it really easy. My wife, I was unencumbered. I mean, she did a lot. I traveled a boatload when I was, pre-CREtelligent, and tried to never miss, school and recitals and games, and I was able to coach. But what happens then is you don't ride your bike as much, you don't fly fish as much, you don't work out as much, and that's okay, because that's where you are in the season, if you will. But I would give a lot of sort of advice around balance to guys or gals that are in these kind of roles, because it will take as much as you can give. There are 80, 90 hours a week. And when people say, I worked 80 hours, let me tell you what really 80 hours looks like. It's like 12 hours a day, 7 days a week, and you're on, right? You're on. And so that's real. If you're not eating right, if you're not sleeping right, if you're not exercising, you're in trouble, in my mind, right? I think those things, when you look at, sort of mental, emotional, physical health, you got to own that, because it's not easy, and you got to have emotional endurance that's going out of style. I mean, in the fundraising world, you better fall in love with the word no. I have talked, in the last 2 months, I've talked to 90 firms, 90. We've got 7 or 8 of them that are really going deep with us. So it's a process, and you got to be, you got to kind of play the long game and be in it, marathon versus sprint. But that lifestyle balance and still taking care of yourself is super important, so that you can go, you can go hard.
Well, it's interesting. You make it a good decision. That's the thing about the decision you made to marry your high school sweetheart. That can go good or bad, but that decision, it's amazing how important that decision is, because you get that one wrong, the rest of it crumbles. I mean, some people aren't going to back the 12-hour-a-day person. Yep. They're not going to tie in with the same values that you have to bring the family so close and unified. They're not maybe going to have that same health aspirations for themselves and for your family. And so, great decision.
Thank you. Yeah, super. And I'm surrounded by a leadership team, Chris and Toby Lutz, who and that are the same. They cut from the same piece. All Sac State grads, by the way. Whole entire executive team, all Sac State grads. So and also have those same values of balance and family, and it makes it easy to navigate the business together. So
I love it. Well, congratulations on your success, and I look forward to seeing what the next few years look like, and the growth of CREtelligent, and anything I can do, I'm here for you.
You're awesome. Thanks for all you do for us in the region, man. Appreciate it.
Great show today. Anthony Romano sharing his story. And to all you out there that are looking up at Anthony Romano and wondering, hey, maybe I can do that too. Well, you know what? Any of us can. You just got to put the right team in place. You got to believe. You got to roll up your sleeves. You got to do the work, pay the price. Anything is possible. So to all you out there fighting the good fight for our freedom, for our security, and our way of life, and of course, all you out there fighting the good fight for entrepreneurship, we're never above you. We're never below you. Always by your side.
Thanks for watching today's show. My goal for every episode is that you find a takeaway, something tangible you can use in your business today. And if you have a comment about a favorite takeaway, feel free to put it in the box below. And if you have a topic that you'd like me to bring up on the show, don't forget to let me know. And also, don't forget to subscribe to our YouTube channel if you want to learn more about entrepreneurship. Because at Haney Biz, we are always by your side.